Hi, I'm Jimmy. In this video, we're looking at the US economy. So we're going to look at different broader economic indicators to look at the raging housing prices. We're going to look at consumer confidence. We're going to look at debt of the average American. We're going to look at inflation, the impact of tariffs on those inflations. And ultimately, we're going to try to identify investment opportunities that work in this particular investment environment. So we're going to go through and come up with a scorecard for each economic indicator, see where the broader economy stands, and then see what that tells us as potential investment ideas today. With that being said, let's jump in and look at our first economic indicator, which is consumer confidence. Now, consumer confidence is crucial because ultimately it's the US consumer that drives the broader economy. Years ago, and perhaps manufacturing played a much larger role in the US economy and the growth of the US economy. But today it's the consumer. We'll see where that goes in the coming years. But for now, the fact that consumer confidence is sitting at fairly low levels historically is absolutely a bad sign for the broader economy. So we jump over and look at our economic scorecard. For confidence, we got to give this point to the bears. Okay, now let's jump over and look at pricing. So for this, we're looking at the CPI, which measures consumer pricing. And I've actually combined this with the chart with the Atlanta Fed. They put out numbers on the average growth rate of wages in the US. And we can see that that number is trending down since COVID, but ultimately it is higher than wage growth. So in theory, this is a positive sign. The idea here is that you want wages to grow faster than prices go up. Now, whether or not this is the best economic indicator as far as the CPI is concerned, this is how much does the average price of consumer goods and services go up. That might not be the best measure because it's not exactly a leading economic indicator. Well, one that is a bit more leading actually looks at looks at the prices to producers. So the companies manufacturing goods in the United States, well, what do their prices look like? What do they pay for those prices? And how does that ultimately will flow through to what consumers pay for their prices? With that in mind, this is the producer price index. Unfortunately, the producer price index right now is sitting, over the past 20 years, it's sitting at a fairly high level. Now, this is going to be highly tied to tariffs. Tariffs, last I saw, the average tariff is at about 18%, the highest level since 34. This is a high level. Now, the reason that tariffs could be such an issue for this economic indicator is that, so whoever's importing the goods is ultimately, so if a company is building chairs and they buy their materials over in China or wherever they buy them, well, those get imported, those prices go up. If those prices go up, this economic indicator will go up. And what is likely, since America is such a, call it, price-driven economy, those prices are going to flow through to the consumer price economic indicator that we saw before. So obviously this being up as high as it is not a great sign. So when we jump back to our economic scorecard, I actually went two ways with this one. I went neutral on the original CPI and the wage growth. Technically, wage growth being still above the CPI is a good thing. But with the producer price index also, looking high relative to the past 20 or so years, and we could have gone back further. It's at a high level right now. That is forecasting a problem coming down the road. So I wanted to make sure that the bears were properly represented in that scenario. Now, along these same lines, and we can kind of see where this is going from a economic indicator standpoint or where the broader economy is going to go. And I'm curious to see how all this plays out with the tariffs and all of that. Well, this is the ISM Manufacturing economic indicator. Now, the key level here is 50. Anything above 50 implies positive growth. Anything below 50 implies negative growth. Right now, it is below 50, which implies that the manufacturing sector in the US is under pressure. So this is a fairly simple one. If it's under 50, that's clearly going to be a point for the bears. So this is another bad sign. Okay, now we can jump over and look at unemployment. This is unemployment. Now, unemployment rate as of the making of this video is sitting at about 4.2%. That's kind of high. I mean, not as high as it was back in COVID, obviously, but kind of high relative to a year ago, a bit over a year ago, is sit in the mid threes. So for me, this isn't a great sign, but it's not exactly a bad sign either. I mean, if we go back and look at the financial crisis, even if you look at COVID, when we go back, that's why I go back so far at these charts, so you could see kind of how it looks compared to the bigger picture. And during the big recessionary times of the US in the past 20 years, well, unemployment is not great, but it's kind of middle of the road. It's going higher. It's concerning, but not a problem just yet. So I'm going to go kind of neutral on this when we jump over and look at the economic scorecard. I'm going to give this point a point to the bulls, point to the bears. This is more of a neutral point. But right now, as you can tell by the scorecard, the bulls are not doing all that great. The bears are kind of winning this one. Okay, now let's jump over and look at housing. So housing is a bit unique. First, this is housing starts. Housing starts, the number of new houses being built. In theory, we want this ramping up. Ramping up, not only does that create jobs, but it provides all sorts of benefits to the broader economy when you have a strong housing market. Of course, higher interest rates don't exactly help that housing market. So if they do start decreasing interest rates anytime over the next year or two, perhaps this could be helped. But for now, we can see that, well, lower lows are being made with this chart in the recent months. And on the high side, well, those are kind of drifting lower as well. So broadly speaking, I would say that this is trending down, which is probably not a great sign. Now, another side of the housing, let's say, component in the United States, and I think that this is actually a bigger problem, is this is the Case-Shiller home resale value economic indicator. And we can see that the average resale value is over $300,000. And I actually think that this is a problem because this ramped up fast. It ramped up fast, but the problem is, broadly speaking, if housing prices go through the roof, if you've got companies like Blackstone and those types of companies investing in single-family houses and driving the prices, it's called a spade, kind of artificially higher, that's going to make buying a house much more expensive. And that could be a real problem for the broader economy. So I think that where for a long time we had kind of a gradual drift higher with home prices, that's kind of what you would expect. This ramp up that we had recently heading into coming through COVID and into recent times is kind of a problem. I fully expected when it ramped up that it would kind of normalize a bit, come down, but it hasn't really done that. It started to, but then it continued higher. So I actually think that this should be a point for the bears, but I think that this is a bigger problem that probably is worth considering bigger term. You're going to have to get a decent pullback in interest rates to really ramp up the housing market in general. But the problem is if you decrease interest rates, that would, in theory, drive housing prices higher. Historically, when rates go down, housing prices go up. So the fact that prices are still rising with interest rates higher is ultimately a problem. This is a bad sign. And I think from a potential investment standpoint, this is something we want to keep in the back of our minds. Okay, now we're going to jump in and look at debt because this is another potentially problematic one. This one is how many people, what percentage of credit cards are late or percentage of customers late, 90 days or more late on credit cards. Again, this is a long-term chart. This is a 20-year chart, and we can see the numbers quite high. Now, it's not just credit cards. If we jump in and we look at automobiles, again, the numbers are quite high. This is a massive problem. You're talking about people have taken on, in theory, too much debt, or perhaps with the housing issue or with employment issues or whatever the situation is, debt is becoming too much. This is a problem. Put all this in perspective, jump over to the economic scorecard. Clearly, this point goes to the bears. This is one of the more, I've done this analysis many times through the years, and this is one of the more negative economic situations that we've seen. In fact, leading into the financial crisis, I had gone back and looked at the economic scorecard. It wasn't all that different from this, a slightly different setup, fundamentally a slightly different setup, but many things, roaring housing prices, debt was getting to be too high. There were a lot of similarities. It kind of rhymed with the situation we're in right now. And to me, that seems like a problem. Now, if we're looking for, if you want to call it slightly better news, I suppose, we can jump over now and look at the yield curve. So the yield curve looks at the interest rate for treasuries at different points in time. So today, if you were to go out 3 months or 6 months or 9 months or 12 or 3 years or 5 years or 10 years, what is the interest rate? Ideally, this should be upward sloping. we want the interest rate it should be lower on the short end, higher on the long end. Now, these are market set rates. I just want to make that clear. This is not something that the Federal Reserve sets or the Treasury or anybody like that. These are market set rates. But the Fed has a major impact on short-term rates. So to the far left of this chart, the Fed has a serious impact on those rates. In theory, if they were to drop interest rates, they would kind of hammer down the short end of that. So the 3-month ones, they don't control that directly, but they have a major impact on it. Let's put it this way. They have a much bigger impact on 3-month rates. They actually control the overnight rate. They have a much bigger impact on short-term rates, 3-month rates, than they do 30-year rates. So if they were to decrease interest rates, that would become more of a normal yield curve. And in theory, that's a good sign. Now, the bad side of this is that not long ago, the yield curve was inverted. Now, we haven't had a recession in the let's put it this way. Every recession in the United States for the past 80 years or something has been preceded by an inverted yield curve. The question is timing. And from the research that I've done, somewhere between 12 to 18 months after an inverted yield curve, within that time period, so let's say up to 18 months, there's been a recession. We've never had a recession that was not first preceded by a yield curve. Now, we have had inverted yield curves that didn't lead to a recession, so keep that in mind. But point is that not long ago, this was inverted, in that the short end was higher than the long end. Now it's kind of flat. This is better than inverted, but because it recently came out of an inversion, I got to give this point more to a neutral point and give a point to both the bulls and the bears. So now when we try to answer the question, do we invest now or wait for the stock market to crash? Well, first, I think that if we're dollar cost averaging, we just want to keep doing that. I think that's consistently always the answer. I just want to remind us of that. If that's what you're doing, just keep doing it. I do think that there's a reasonable chance of a pullback or a stall out in the market. Now, the tricky part here is with the market actually doing fairly good, we just recently broke all-time highs again, as it has, many times over the past, 20 years. Well, with the market doing fairly well, it's kind of difficult to find good investment opportunities. Well, over on the Investors Grow website, when we jump in and look at some broader economic, let's call it individual charts for different sectors, originally I started looking at utilities, but as you can see here, utilities have done fairly well. Then I jumped in and looked at consumer staples. Consumer staples are companies that, in theory, are companies that you have to keep buying. Think milk, bread, things like that. Those types of companies can fall into consumer staples. Consumer staples over the past year is fairly flat, and I think we might be able to find some individual opportunities that could make sense to get defensive. Ideally, you want to get defensive in your portfolio before the market were to crash. If the market were to crash, being defensive, those companies will tend to buoy your stock portfolio, and they can do much, much better because of it. So I think, for me, on a personal basis, I'm going to look in this sector. Now, if you have any ideas for individual companies for that I can do some research on, please let me know in the comments below. And if you want to sign up to get access to the Investors Grow website, I'll leave a link right here and a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.